Welcome to the ALX Show, where we talk faith, family, and all things real estate. Let's get to it. Hello, Josh, and welcome back to another episode of the ALX Show. Today is kind of an interesting day, and I'm excited to get this episode out into the world quickly because we are talking about the yen carry trade and just some different things that are happening in capital markets around the world. Today, as we're recording this, so this is Monday afternoon, there has been a lot of action in markets today. So the headline on the Wall Street Journal right now is Dow sinks 1,000 points as global sell-off intensifies. And so we are currently at 2.7% down on the Dow, 3.3 down on the S&P, and then almost 4% down on the NASDAQ. And what's interesting is the VIX has shot up. I think it's currently like 52% up, but it was like double what it was last week. And then we've got the US 10-year Treasury note is at 3.762 right now, which is much lower than it's been over the last weeks and months. And so I want to get into that and how it affects real estate in general, especially the kind of things that you guys are watching, you and Patrick and Christian at ALX. But before we get there, I wanted to just give like a really brief recap. Like, okay, what is the yen carry trade? What's happening in Japan? How is that, kind of working its way back into U.S. markets? Because I think the Nikkei or the Topics Japanese market, its biggest single day fall since 1987, since Black Monday, like 40 years ago. So some big things are happening. And I just wanted to catch up listeners on hot take summary. What's going to happen? What do you think?
Yeah, like you said, it's been a crazy day. Let's go back to last week. That's really when things started is with the jobs report last Friday, coupled with some weak economic data, especially in the manufacturing data that came out late last week. And I'm sure, you probably saw this. The unemployment rate jumped to 4.3%, which triggered the SOM rule, which is basically about the kind of the moving average of the unemployment rate average over a certain period of time. And once it gets elevated to a certain point, it triggers. It's been, I guess, near perfect in predicting recession. So we triggered that on Friday with the 4.3 with the 3-month moving average. I think being higher, 50 basis points higher than the highest point of the last 12 months. I think that's generally what it is. We can always go back and look that one up, but lots of things. Unemployment, the continuing unemployment numbers were elevated. We also had just initial jobless claims were up last week. So there's just a lot of stuff, right, that came out that got a lot of people nervous that were probably already on edge, right? I mean, we're just in a weird time. Like the stock market's hitting all-time highs. Bond yields are way up. Meaning their prices are way up. So are way down. So everything is just in this kind of like weird wait and see what's going to happen. The Fed didn't move, last Wednesday when a lot of people thought that they should. Now everyone's saying that they should have moved, right? They missed a golden opportunity to cut 25 basis points last Wednesday. It's just a strange time, because 2 weeks ago or even at the beginning of last week, we're talking about all-time highs on the stock market. And now we're sitting here looking at, like you said, I mean, I'm looking right now, the Dow Jones down 3% across the board. NASDAQ's closer to 4%. Russell 2000's right up there, almost 4% as well. So yeah, we're getting hit all over the place here.
It is a weird time. We were talking before we started recording. We haven't, as a family, I have not been in the stock market for a couple of years, for different reasons. But we just didn't have a money in the markets. And 2 weeks ago, we met with our financial advisor and we're like, all right, it's time now. This recession everybody's been talking about for 3 years is just not really playing out. Let's just jump back in. And then here we are today. So, poor timing. But like you said, nobody ever knows this stuff. You never know what's going to happen tomorrow or the next week. So,
no. And last week it looked very different. Like we said, we kept hitting these all-time highs.
Yeah.
I think like you and I talked before, if you're in it for the long haul, then you're going to be okay.
Yeah.
Typically, I think the long-term, like average gain on the stock market is I mean, was it like 10% a year, something
Something
like
like
that? I mean,
that. Yeah.
it's a good number, but I've also seen that you've got like there's only a handful of days almost per year that see the most appreciation. So you
Right.
really got to be in the market, right?
Yep.
So, but if you've got that long term approach, I my opinion, obviously, I don't know what the future holds,
Yeah.
but history would tell us that you're probably going to be okay.
Yeah. Yeah. Agreed. Agreed. It's one of those things you got to keep your emotions in check. So tell me a little bit. What you've been doing some reading on the yen carry trade. There's an
Yeah.
article that was helpful, and I've been reading Wall Street Journal and The Economist had some notes on it today, so we can talk about that. But give us like a quick, what's your 30-second summary of what your understanding what the yen carry trade is and why that matters.
Yeah, happy to. So this article is from Barron's. It came out this morning or earlier today. It says in the yen carry trade, investors borrow and sell Japanese government bonds that they do not own. The cost is small because Japanese bond yields are low. The investors take the yen they receive, exchange it for US dollars or euros, and invest the new currency in bonds or stocks in those markets. It's a fine strategy if currency values don't change much, but now the surging price of the yen has eaten away much of the potential profit. The surge in the yen started with the Bank of Japan officials talking hawkishly about raising interest rates in recent weeks. The central bank raised rates to positive territory for the first time in 17 years.
Hmm.
Higher rates typically help currencies. Investors have to own local currencies to buy bonds with attractive yields. It says here, meanwhile, the U.S. Federal Reserve's discussion of cutting rates in recent week economic reports have put downward pressure on the U.S. dollar. So it's just,
Hmm.
we're shifting. Like the strength of the currencies is changing really quickly.
So if
I don't know much about this, Brandon. I don't
yeah.
know much about the carry trade. We know that clearly it's having a big impact. I know you've been reading about it too.
Mhm.
It really just came to my attention here recently as we see like, well, why? Everyone's asking, why is this happening?
Yeah, yeah.
So it's fascinating to me. I love reading about this stuff. It doesn't impact me what I do professionally, but it is fun to know or try to learn the root causes of why things are doing what they're doing. What do you think? I mean, what are you seeing? What are your takeaways?
Yeah, I'm not, this is not my area of expertise by far, but from what I gather, money was very cheap in Japan because they had let interest rates be, zero basically for a very long time. And now opposite other central banks around the world, they are starting to raise their interest rates now, which makes that money more expensive. And therefore, their investors are dumping those assets and dumping, unwinding those trades. Um, and so that's, yeah, just putting pressure. It's like a margin call basically around the world that they've got to find some new capital elsewhere, and it's not yen apparently. But what is interesting to me is this is from the last paragraph on this Economist article. It said, for now, the slump appears to be driven by this unwinding of speculative bets, that what I just
Mm,
talked about there. And it said, few analysts think the Japanese firm are in deep distress or fear the stability of the country's financial system, but the rapid changes in Japan have knock-on consequences. As interest rate moves make the carry trade less valuable, they could fuel a sell-off in far-flung corners of foreign markets. And this is what's interesting. Japan is also the largest creditor in the world. The country's investors owned $10.6 trillion in foreign assets at the end of last year. They have become big buyers of American and Australian collateralized loan obligations, for instance. If the stronger yen means these investors need to dump foreign holdings to meet liabilities at home, that could weaken asset prices while driving the yen still higher. Just how much further the yen has to rise and Japanese stocks fall remains to be seen, but until investors' speculative bets fully unravel, expect choppy market conditions. So what I thought was interesting, and I don't know if you have a comment on this or anything, but I just thought it was interesting that Japanese investors with $10.6 trillion in foreign assets, a lot of that, it says that they're big buyers of American and Australian collateralized loan obligations, which makes me think, rightly or wrongly, again, I'm not an expert, that's a lot of real estate, right? I mean, you kind of collateralize a lot of these loans across mortgages or commercial real
mhm.
estate or whatever, and kind of sell those, securitize those and sell those. And they
Yeah.
have bought a lot of those. So I don't know if that harkens back to the last financial crisis or anything like that, but it makes me interested to see if real estate is, a link or something in that market.
You know, it is. I mean, the CLO market is a big source of financing for real estate, and it goes back to supply and demand. I mean, if you've got less demand for these bonds, these securities, then the prices you're gonna have more supply, which is gonna push the price up, which is gonna make borrowing more expensive. So we'll have to just kind of wait and see, right? How this plays out. If the Japanese investment into not only CLOs but also treasuries, like if all of a sudden we get a pullback from foreign investment in those two things, then that is going to have a significant impact on our borrowing costs.
Mm.
Because our borrowing costs, especially in multifamily and commercial and some of the bigger asset classes, typically are driven by securitizing or securitization of these loan products. So when you sell those on the backside, then it's all driven by demand. Like who wants them? And if not a lot of people want them, or if you lose a big player in that area, then the prices are going to come down, which means the yields go up, and that means that we pay more. So it's certainly something to be aware of. I don't know if that by itself will have a big impact on the credit markets here, specifically in DFW or in the United States. We'll just see. I mean, it seems like it's hard, like it's of course will have some level of impact. What it is, we don't know quite yet, but certainly something to be aware of.
Yeah.
That, the economic, this global economic system is so vast and so complicated.
I know.
And so big. There's so many moving pieces. It's so hard to keep up with it all, and really to make sense of everything that happens, because it all happens so fast. And just like over the weekend or late last week, you kind of think things are one way, and then seemingly overnight they're not. All of a sudden they're very different. And all we can do, right, is we do our best to try to understand what's going on. But this is not, we've got jobs that involve specific operations and making sure that things are going well outside of understanding on a bigger picture where we are economically. But we've got to do our best, right, to stay informed. We've got to do our best to keep up. Otherwise, we're gonna have a really hard time forecasting or putting together any type of valuable outlook.
Yeah.
So it's important. This Japanese yen trade is it's beyond me. I need to study it a little bit more. I don't quite understand
I don't
how it works exactly, but but what we need to understand is having a real impact. That's really what we need to be aware of, and how far do we think the impact is going to go?
Yeah. Now, I got an MBA in finance, and I read dozens of books about capital markets and economics and all that kind of stuff. And all I took away from it was, wow, that is complicated, and I should not be in charge of doing this for other people, because that sounds really complicated. So given all of the market turmoil, what advice would you have for someone? What personally, professionally, spiritually, how do you interpret this and think through a framework to offer people to take away? It can be crazy, it can be fearful. Is there hope, or is it like, nope, doom, it's going to be terrible, brace yourself?
Man, that is a really great question, and it's one that it does really, it causes you to think about where your hope is, right? Who do you trust? What do you trust? Are you just kind of waiting for economic data to be just right before you make your move, before you do what you're supposed to be doing? Now, there's also times to wait, and that's where I would go when what's happening here is I would not be overly aggressive. We're not going to be overly aggressive when there's so much volatility, because we can't see any further than anybody else, and there's certainly going to be opportunities. People are going to pull back, probably out of fear, or maybe a misread, different reasons, and we're all susceptible to that. But I think you stick to the plan, you stick to the fundamentals. It doesn't change the core competencies. It doesn't change your underwriting. It doesn't change your vision, your business plan. It may change your business plan and take that back because you might just on timing maybe.
Yeah.
But my suggestion would be that you sit back just for a little bit and you let this play out. You let it play out, kind of see what the Fed's going to do, and we get ready because in any time there's market volatility or turmoil, there is opportunity, and that opportunity comes, from all of a sudden maybe we're in a better lending environment and we don't have a recession, so it means go get the refis done, go buy the new assets. Maybe it means people got washed out, competition got washed out, or competition decided they were going to take a longer break. Well, then you got to go. You got to go because that's your opportunity for market share.
That's right.
There's also an opportunity for this, like to be a voice of information and to have an educated opinion so that you can attract more people to your brand, hopefully because you're providing some value, because you're a one-stop shop for what's going on and how it impacts, what we do specifically. That's all that we feel qualified to talk about, which is, DFW real estate. So there's lots of opportunities. There's also, I think you've got to be prudent. You've got to be wise. You need to be praying. You need to have peace before you move, but never lose hope, right? I mean, there's no reason to ever lose hope. My hope is not in the market. My life would go a lot easier if if the market goes a certain way, if the real estate industry goes a certain way, then yes, life is easier. And of course, I'm always, hopeful, just as humans myself. I mean, I'm always up for a challenge, but yeah, if we can get through some of these, like get just beyond and get through these last couple of years, that'd be great. And I think we're starting to see that, but it's just like, this was all predicated on one big data point last week. Now that's maybe that was the last big data point after several like obvious signs of weakening throughout the economy. So maybe it wasn't just one, but it was a big one. The jobs report was a big one, especially the unemployment rate. But let's just wait and see. I think we're going to get that cut in September. I think it's going to be cheaper to borrow. I know it will be. Spreads will go out. The lenders will push their spreads out, even if the indexes come down. So it won't just be basis point cheaper, but it will be cheaper, which is great news. That means less cash in for operators. Maybe like these commercial operators, certain multifamily operators, we can all take a little bit of a sigh of relief. All right, at least we know like inflation seems to be on the back burner. There's not a lot of concern. You don't hear a lot of concern about it rearing itself back up, right? I mean, now we're all concerned on labor market and production, and trying to stave off of a recession. So you don't hear a lot about inflation, which was the last time we could say that.
Yeah, right.
And we also got some good prints, right? I mean, what did the CPI came in last at 3%? Core was 3.3. So it's not down to the 2%, but that's on the CPI. The Fed they track the PCE. It's down to 2.5. Core's at 2.6, and that's just that's just the difference there is just gas, just oil. So, and that's moving though. That's something that we got to keep an eye on. Oil's that's odd, right? We're talking about recession. We got all this Middle East turmoil, but oil is not spiking. So that's another interesting thing to keep an eye on. We certainly want low oil. That definitely helps with keeping inflation at bay. I mean, that impacts just about everything. So prices across the board. So anyway, that's a long answer, and I don't know that there's a good answer. I think my advice to anybody right now would be just to hang in there for a little bit longer, but stay ready. Stay ready. If you have assets that need to be refinanced, get them ready. Be ready to move quickly. If you're looking to purchase or sell, then I think that we're once we get through this volatility and things stabilize, then the transactions will start to pick back up. So just hang in there, and watch the markets. Watch the markets. Stay. Make sure you're taking care of business in your own house, within your own operations, but just be aware of what's happening.
To quote Warren Buffett, be greedy where others are fearful, right? So if this is
hard to do.
If this is a fearful time, just take a look at what's going on, the opportunities that are going to present themselves, because they will. They always do. Josh, thank you so much for your insight and your wisdom. I know you've been through this a time or two, and so I'm keen to see how this will play out and how you guys will fare at ALX. I know you're always watching for some great opportunities that are on your way. So looking forward to chatting and picking this back up next week and seeing where things shook out from market turmoil this week. Thanks.
Sounds
again.
good.
We'll
Thanks,
see you
man.
then.